you, but real people names. That's not my department.
Fry burger with an A. That's what I say.
There
Ain't
it is.
J.
That works.
How's it going, gentlemen?
Yeah. So the government's shut down. Market
Apparently,
actually,
yes.
Market actually sold off a little bit into the close. Interesting.
Yeah.
Glenn actually brought up some interesting data points earlier today related to how market shutdown could be bad for a U.S. dollar in the short term, not so bad for equity markets. It's interesting.
But of course,
this is sort of the essence of what we've been talking about this week, right? In anticipation of this thing going down, is do the markets actually care about any of this? And it seems like even at the onset, I mean, obviously going into this overnight, I mean, futures were down all night. So Europe didn't like it. Asia didn't like it. We had some pretty hairy wicks. I mean, if we look at the S&P here, we can see that overnight things were definitely a little spicy. So looking at sort of where we got the S&P at one point, S&P futures ES was down something like almost 1%, like maybe 0.9% from the close yesterday. But obviously, we are not doing that here. So U.S. markets seem to come in and think, yeah, this is nothing. This is fine. Is this just because we're expecting for all of the posturing to eventually give us an answer? I mean, I think Westwater had a great chart that he's been sharing all week that basically says the longest shutdown was the 30-plus days in 2018, and markets were up. So ostensibly, is the framework here then, well, if it's within 30 days-ish, then we've seen this movie before and it's not painful. So I'll see you in a month? Is that what this is?
I mean, I would take it one step further and say that even the last occurrence, 35 days, I mean, that was a long time. And so
Yes.
I wouldn't necessarily be looking at a month. I'd honestly be looking at next week. I think we knew that this was coming as far as economic data not getting non-farms this week. We got a number today from the private ADP.
Did we ever?
And we're pricing in now for pretty certain a cut in October and not needing another data point to confirm or deny that. I think everyone's comfortable with thinking that the Fed is comfortable with that. And so I would look to next week, just because in looking at the previous, 20 shutdowns, the median duration of it is 3 days, and the mean being, I think, around 8. And that's skewed heavily by the last occurrence.
By the 35, yeah.
And a couple others that lasted 2 weeks, roughly. And so I'm looking at next week just to see if this is one of those blips. Okay, we needed everyone to get on the same page, past whatever we were close to, or if there really are holdouts and we end up with a continuation package that isn't what people are expecting. That's the only thing I'm thinking of, not playing in the consensus right now.
Yeah. I mean, markets are drifting higher, volatility getting crushed. The prediction markets have this shutdown lasting 90% of the probability based on betting markets is at the very least October 6th to 9th. And then it's about a 30% chop between that week, the week after, or the October 15th or later selection. So 90% of bettors are saying it will last till the 6th.
So a little weekend retreat.
Yeah.
Get all your ducks in a row.
Yeah.
Come with your answers on Monday.
Yeah. To Glenn's point, though, the CME FedWatch tool, where we look to gauge probabilities of interest rate cuts, that was already pricing in a strong probability in the October 29th decision.
Yeah.
Also the 10th, but now it's a stone cold lock. 29th has a 99% chance we get another 25 basis point cut. And December 10th we also are getting a nice 10% boost from yesterday. So just from yesterday to today, it went from 77% to 87% that we get yet another 25 basis point cut. So the market is pricing in 25 basis points in the next two decisions. Wipe our hands, SPX to 7,000. That's my prediction.
Because what could we hear from now until then that would dissuade you?
Yeah.
That's exactly what I've been looking at here, because since the 18th, since the Fed issued its announcement, you got 1 day of, hey, we got the cut from markets, and then everything stalled. And the dollar tellingly came up, yields came up. The markets clearly said this was not hawkish enough, or this was not dovish enough. And as you got some of those expectations loosening a little bit, especially for December, the markets went, whoa, hold on. 1 second here. What? And the S&P kind of stalled. And we had a little pullback there. We had a little pullback in the NASDAQ. To both of your points here, the defining feature of this rally today is a rebuilding of rate cut expectations. So the market here is basically praying for rain. It wants a weak economy because what it wants is the rate cuts. It's almost as if the market has said, you know what, bad things may happen. We may even want some degree of bad things to happen, as long as the cheap money is coming to insulate us from whatever risks might arise. The cheaper the money, the better. Because then, sure, things might go wrong, but if the money's cheaper, then we can take a loss, borrow again, roll it again, and that's fine. As long as we have the bulwark of cheap money.
So then the disconnect to me is, we were talking about yesterday, is the Russell interesting? We kind of argued, hard to say moving with rate cuts. I don't know now, is this a confidence signal for you, Ilya, in the Russell, or not really the magnitude I would have expected? If it was
not really, I would have thought that Russell would do better. I think one of the interesting things here today is the S&P is outperforming even relative to NASDAQ, in the sense that at least the S&P attempted to breach its swing high. NASDAQ didn't make it, but one of the more interesting things here, it's healthcare that's pushing this thing. That's easily by far the best performing sector today. And of course, it was the worst performing sector yesterday. So you get this. I mean, if we look at XLV here, it's basically all pinned on one thing, right? So you had this extended pullback in September, and over the past 2 days, it's just a fire hose. And this is not a macro story. This is a healthcare story. This isn't carrying over elsewhere. So you sort of wonder what this is. In particular, perhaps with the shutdown. I mean, that's not the part of the economy that's going to get terribly impacted.
Yeah, if you look at the S&P 100, some of the top movers the last couple of days, Eli Lilly, Merck, Pfizer, Amgen, AbbVie. So all these health-related or, pharma-related companies definitely seeing big moves. Merck looks exactly like XLK from a chart standpoint. Or not XLK. XLV.
And this is all on Trump RX?
I guess.
So, interesting thing here. I was looking at a list of furloughed federal employees as a consequence of this, the share of employees furloughed by department. So if you look at commerce, education, and the EPA, over 80% are furloughed.
Oh, wow.
Health and Human Services, 40%. Veterans Affairs, 3%.
Oh, wow.
So Social Security Administration, 12. So when you look at sort of the names that would be impacted by a shutdown, let's say insurers, hospitals, healthcare names, those parts of the government are not really shut down. That business is going to continue. I mean, Medicare, Medicaid, they're not getting turned off. I mean, rightly, of course. But those are vital enough that this shutdown doesn't go there. So, yeah, I mean, there's been obviously a one-off catalyst here in healthcare, but at least in terms of doing no harm, this is medical jokes. This sector is not a shutdown victim, you would think.
How much more does it got? No, is this, I mean, now we're back kind of in the middle of a range. It's broken out from its range, but is this still interesting?
I think it's interesting in terms of like a sector rotation, for sure. I mean, you have different sectors that make up the S&P, and one sector in particular has blown the roof off in terms of concentration and the gains on the year. So like, if we are to see this continue, could you see maybe a flattening of like the tech stocks and then a rotation into these other lagging sectors that would bring the whole thing up? I think that makes sense.
I agree.
I mean, but from an XLK standpoint, huge move over the last 2 days. The last 2 days, we went from basically 134 to 144, we'll call it 10-point range. If you look at future implied volatility in XL, do I keep saying XLK?
You do.
XLV. XLV, where's the next 10-point move priced in? Not till the end of the year. So in 2 days, we've realized a move greater than the implied volatility priced into the next 80-day cycle. So sometimes.
So should we just sell this vol then?
Well, there's no vol. That's what I'm saying. There's no vol. This is just a move. This is a realized move that's not priced into vol. So if you're gonna trade this, I think you stay defined risk. I don't see any reason to sell premium in here when you can just buy options for $200 that are 90 days out. You could play for the upside or downside. I think that's where I would go. You could diagonalize it, do a zebra, something like that. But with sub 20% IV in a product that just moved 10 points in 2 days, I think that's where you go if you're trading this. Just defined risk directional.
And I would imagine in your mind, it's directional upside, especially given the strength of the breakout here.
Yeah, if you're playing for like a move back to 150, in theory, you could get that tomorrow. So,
I mean,
yeah, these options are cheap. Like these options are dirt cheap for a potential move back to recent highs. The markets are kind of wide. Could be just a fact that the market's closed, but tomorrow I think it'd be interesting to check out, especially if there's a flattening of this move or maybe a little pullback, and you want to play for year-end XLV getting back to highs. It's a very cheap way to do it because the IV, although IV has increased into this move, 2.4% is nothing in the grand scheme of things. When you go from 15% to 17%, like this is a scenario where I don't care what IV rank is. IV rank could be 100. If IV ranks 100 and I look at the IV and it's only 20%, that doesn't really move the needle for selling premium. Like I want to see premium in the 50, 60% range, which you're not going to see unless there's a market meltdown. Like you only see the S&Ps and NASDAQ in the 50s or 60s when there's a market meltdown. Here, same story. It's kind of just look at the IV. If we're under 20% in any product, I'm going to lean more towards a debit strategy to define the risk and just play for a directional move.
It's how I end up a lot of times being long premium is vol is relatively cheap and you can get much better risk reward. I mean, you can basically lock in a 2-to-1 risk reward, sometimes better risk defined. Why would you not do that?
Yeah. And I'm willing to bet, yeah, these options were basically worthless 2 days ago. These are trading for 20 cents. Now they're $2. So
Hence the IV rank.
exactly. Yeah. It's sometimes you have to always take everything into full consideration. And for a product like XLV, XLK, any of the XLs, I'm almost always going to lean towards long premium just because the premium itself is just not there. And you're still getting moves like this that will pay you off if you're directionally right.
Yeah, you can get really IBIT actually is sort of similar to this, where you can get incredible risk reward just being long premium. I mean, sometimes like 3-to-1, 4-to-1, just because it's so cheap.
Mm-hmm. What else you got your eye on in this magical market, Ilya?
One of the most interesting things, and I don't know if it's time to attaboy myself yet, but at the very least, so we started this week with a conversation saying a shutdown, well, the scuttlebutt being a shutdown would be bad for the US dollar, and me arguing no, it wouldn't. It wouldn't be bad for the US dollar. And boy, did the dollar turn today. So it started off bad for the US dollar, again, in the overnight when European and Asian traders seem to be taking the shutdown at face value. But my God, the reversals. Euro couldn't make it stick at all. The yen probably had the best showing of the bunch today, but the euro couldn't make it stick. The Aussie couldn't make it stick. The pound gave away almost all of it. The Canadian dollar is actually down on the day. So is the franc. So you look at this thing and you go, well, why? Like, of all things, how is it that the dollar is holding up this strongly? I'm happy that it is, of course. I've been looking for it at the bottom since July, so I'm long, and I'm staying long, and I'm getting more long. It hasn't made its move yet, but for all the dovish talk, for all of this apparent structural concern, the dollar is up. And in my mind, it's up because it's up for the same reasons that gold is up, interestingly, which is to say that there is a lot of uncertainty and defensiveness. And when you look at gold and this most recent rally, and silver too, it's been completely disconnected from yields and from the dollar, which are usually its catalysts. So if you look from mid-September, gold and silver rip at the same time that the dollar is recovering and yields are going higher after the Fed. So this is something else. This is not gold and silver being kind of the usual anti-fiat foil, the usual anti-interest rates foil, because, of course, they yield nothing. So this is something else. This seems like the market basically going, you know what? We don't know what's going on, and there's a bunch of idiosyncratic risk on the board. There's, well, maybe the president's tariffs are going to get overruled by the Supreme Court, and that would take 4 or 5 months of benchmarking in markets and toss them out the window. Maybe you have some sort of a Fed situation. It can go either this way or that, but just today we learned that the Supreme Court said Lisa Cook, the governor that the president is trying to fire, can stay at least until January, when her case is going to get looked at in oral arguments. So maybe there's some kind of a confrontation here where the president gets told, no, you can't infringe on Fed independence, and then all kinds of things follow on. There's just a lot that's up in the air. I would think the tariffs most significantly. And the market seemed to be going into some sort of a, you know what, where can we go to park some capital to not think about these things? And gold and silver stand out, and maybe the dollar too, because I think since April, the dollar has really found its groove as a haven once again. I think in sort of late March, early April, there was definitely that Liberation Day kerfuffle where stocks and bonds and the dollar were all going down at the same time because the markets were afraid that maybe the U.S. government has gone so crazy as to cut off its nose to spite its face. Like maybe it really does want to pull apart the architecture of the U.S. dollar and the treasury bond-based global financial system. And then the president backed off. And market discipline worked. And the president said, oh, whoa, 90-day pause. Hang on, everybody. Stop that. And then the China deadline got extended and extended again. And we got sort of semblances of deals with other main trading partners. Sans Canada, that's probably coming. So, I mean, we're running up to the renegotiation of the USMCA next year. It's not illogical that this one is a little bit feistier. So you get maybe a dollar haven bid again because the markets go, oh, they're not going to structurally undermine the dollar. Fine. It's still a haven. It's still the cash of choice. Its role in global commerce as the cash of commerce, that remains. And the U.S. is not going to shoot itself in the foot in this sense. So, okay, fine. I like the dollar here. It is defying any kind of news interpretation you might have, and that's a sign of even greater strength, I think.
Yeah, I mean, shutdown aside, with how clean the move was in, rate cut expectations, I was definitely surprised that we didn't at least see, some consistent skid throughout the day in dollar prices. Did get a bid back up throughout the U.S. session, not moving with those rates. But no. Yeah, I think today and yesterday kind of contextualized this shutdown for me in an important way of thinking, of course it's not fun, but a dramatic headline to talk about government shutdown. But when you really think about what's burdened the U.S. dollar so far this year, what we're looking at right now is just a congressional disagreement that we've seen 20-odd times before. Nothing really as uncertain as what we've seen, from the administration early in the year, with all those tariff uncertainties, as well as the Fed independence piece that I think definitely hampered a dollar price action throughout the summer as well. And so those pieces staying put really have supported this stronger than I would have expected, with the news of, perhaps successive rates, very likely, as we talked about, most of that price action is now playing into 2026. Markets looking really far ahead in terms of what kind of the neutral rate will be for this cycle, as opposed to does the 1-2 cuts come October, December, October, January. I think it's the whole scope of the cuts that's the story now.
Definitely.
So, I think
definitely. I mean, to me, this has been the biggest deal, is that the markets and the Fed are far apart on next year. This year is kind of a given in a lot of ways because the calendar is so limited. And it was already so limited by September. I mean, they had 50 basis points on the board that they themselves predicted as of June. And by September, they had 3 meetings. There's only so many configurations to do this easing when you've got 3 meetings left. So whether they do 50
sans jumbo cut.
Well, sans jumbo cut. Exactly. And given how reluctant the Fed has been, jumbo cut was never something with serious odds. So you look at this and you go, okay, this year is kind of a given. The question is next year. And there's still a wide gap between the markets and the Fed. I mean, the markets are at 63 basis points for next year. And that's what, at least 2 cuts and about 50-50 on a third. And the Fed's at a quarter. That's it.
Hey,
they're only looking at 25.
Get your mortgage broker on the line. You might have an opportunity to refi, baby.
That's right.
We get down there.
It's an interesting thing because let's assume that we don't get NFP on Friday, right? Let's assume the BLS does not let us look at the numbers. Okay, ISM will still come out, so that'll be an employment indicator. The service sector ISM is obviously a huge thing for employment. It's by far the service sector, by far the biggest employer of Americans, and that will have some jobs data baked into it. And obviously today we have ADP, which is something that Glenn, as you were mentioning, that came out either god awful or great, depending on your perspective. God awful in the sense that it was a 32,000 job loss that came out against expectations for a 50,000 jobs gain. The prior month was revised from a 54,000 jobs gain to a 3,000 jobs loss. So that's the 2 consecutive months now of job losses, according to ADP. And that's the first time that we've seen something like that since 2020. It's the first negative, or the largest negative reading since March of 2023, which was a one-off, just a weird month. But we haven't had back-to-back job losses from ADP since COVID, since basically the onset of COVID. So if this is the only data we're going to have, and ISM is not incredible, then the markets are going to look at this and go, well, I guess the labor market is terrible. I guess the Fed's going to cut rates a bunch. BLS could have told us something different, but I don't know what I don't know.
It's true.
Yeah, I think the no bad numbers, no problem sentence is going to fly around for a little bit here.
Don't worry, no cry.
Yeah, the lack of numbers, lack of things that can turn this ship around. We're in for some low volatility times, I fear. I did put out a poll on the YouTube chat earlier today. My poll question was, what breaks first, the equity market or the metals? 66% said the equity market breaks down first, which I kind of agree with. All things said, I mean, if the narrative is there's fear in the market, we're placing cash into a product we trust, like gold and silver, or even Bitcoin, seeing a nice rally the last couple of days. I tend to agree that even though these moves have been so astronomical in gold and silver, and both of these also have exceeded implied volatility to the upside, I would be more surprised to see these come down to previous levels versus the equity market coming down to 6,300, 6,200, something like that.
Yeah, I mean, I think it's an interesting conundrum. I would think that if gold and silver were powered by the usual catalysts, if we were talking about yields, if we were talking about the dollar in particular, you'd think would be exerting some pressure here because it seems like it wants to turn. It seems to be shrugging off negative thing after negative thing. And if the metals were a foil for fiat currency, of which the dollar is the benchmark, full stop, you'd think, okay, herein is the danger. The dollar is building a bottom. It's going to have some sort of a rip. That rip might be because the economy actually looks like it's heating up, jobs data notwithstanding. I mean, the Atlanta Fed GDP now tracker is steeply climbing. The Citigroup index of U.S. economic data surprises is steeply climbing. So ADP, I'll save my words of disparagement for that indicator. But ADP notwithstanding, because it might actually matter this month, ADP notwithstanding, U.S. economic data has been relatively good, at least like compared with forecasts. And so, and what the GDP Now tracker is telling you. It's not telling you anything about GDP. Forget that. The important, I mean, that'll be for the third quarter, which is ages away still. It'll look very different by then. The important thing is you can see the trend in the model. So you can see that the data going into it has been GDP positive. That is relatively positive data. So you could say, okay, well, the risk to the metals is the rate cut calculus is wrong. The Fed is right. The economy is actually heating up. That's why they forecasted faster growth next year in the latest SEP. That's why they forecasted faster inflation, lower unemployment. They see it. The economy is actually accelerating. And because the economy is accelerating and the labor market is a lagging indicator, they're not going to need to do all the cuts that the markets think. There's your dollar catalyst to really go. And that could boost yields, that could boost metals. Or that could hurt metals. Right. But metals don't care about that here. And so actually, I think that narrative might be a bigger risk for the stock market, interestingly, than it is for metals. Because stock markets seem to have cared a lot more about, oh my God, just don't take away our rate cuts. We'll do anything.
Please.
We'll do anything.
Yeah.
Just don't take away our rate cuts. I mean, you see it just in the way that they've behaved sort of during and since the Fed. You're watching it here right now in real time. So if what's going to happen here is the data ultimately says you don't need this many rate cuts, the markets are out on a limb, the Fed's been right, they're not going to go that hard because the inflation risk isn't going away that quickly, and it isn't, then paradoxically, I mean, normally you would think that's a much bigger risk for gold than stocks. Right. But in this environment, I might actually think the tables have turned.
I think you're missing one piece to the puzzle here. Curious to hear your thoughts on it. Big mover of the day. We've talked dollar, we've talked gold. Digital gold. What are you thinking about crypto? Crypto mover
I've
of
been
the
talking
day.
Smack about it all day.
And here we go. Giddy up.
He's the only crypto bear I know in the world.
Does that fold into any sort of calculus in that view? Do you see this moving completely separately from all of that?
I do. I think, well, so to me, crypto is up because stocks are up. Because to me, crypto is not gold. I mean, obviously. Just look at a chart of crypto, then look at a chart of gold. If crypto were the same kind of asset that gold is, this would not be a chart that's been stuck in a range since early August. It would be ripping, which is what gold is doing, which is what silver is doing, which is what other precious metals are doing. This is not gold. This is not a store of value asset. Nobody's confused. What this looks like, much more so, is the stock market, only soggier because the stock market is doing better. So, I mean, overlay a chart of Bitcoin and the S&P, and you get basically a kind of lazy stock market over the past couple weeks because it's done less well than stocks have generally. And so, to me, what this is a kind of barometer for risk appetite of the exuberant kind. And so there's a kind of gradient almost, like how risk on are we? Are we risk on to just buy stocks, or are we risk on enough to buy crypto?
I'd argue that it's risk on and with the flow of money, like how free are funds. Less so a risk and more risk. But I think you do, if you're folding this into the rate cut story, these crypto markets will be more lagged than a stock market, moving less on anticipation of lower rates sometime in the future, but here more would get more lift from the actual real-time effects of lower rate cuts, as we've seen time and time again
Well, yeah, I
in
mean,
lower
that's
rate
the other
environments.
thing. To your point, that's the other thing. Crypto is not really responding here in a way that you'd think, oh, goody, so much liquidity is coming because the Fed is going to cut rates. It's not doing that. It's been stuck much along the same lines as the dollar has been bottoming. This has been struggling to rally. So in some sense, it is almost inherently being held back because it's priced in dollars, which is the great irony of ironies for this whole thing, right? Is it's not actually money. It's just it's just a speculative asset. And by the way, any pretensions it had to being money went out the window the moment they made ETFs out of it. So any kind of this is sort of like the original sin of crypto. Like, we're going to create an asset outside of where governments can mess with people's store of value. And then what we're going to do is give all the regulatory agencies say over all of it as a condition of giving it enough liquidity that would have made it a contender to be money in the first place. So without government's hand in it, it couldn't be liquid enough to be money. And when the only way to get it to be liquid enough was to get government's hand in it. It's not money. Certainly not alternative money.
We'll see. It's one for one. No government, crypto up. So
Hey.
we'll see how long it takes.
But to Ilya's point, yeah, strong positive correlation with IBIT to SPY, 0.4 correlation to SPY in the last 3 months. I would argue it's more correlated to tech stocks.
Yes.
But yeah, strong positive correlation. Still super volatile. And I think it holds a place in a total portfolio because of that volatility, for sure.
Sure. For a trader especially.
Yeah. Absolutely. I mean, that's
now that you have ETFs that are on exchange and you don't have to think wallets and this, and you can basically look at this like any other ticker. Why not?
Yeah. But yeah, IBIT's been a great vehicle for short and long premium trades all year. But that's because it's had two-sided action, big swings in either direction. That's kind of what you need. But yeah, I think there was a question in the YouTube chat. Is there a scenario where both go down at the same time, equities and metals? Or do you think the metals move is so strong and the narrative is so strong for an anti-equity market play that you would...
There is a scenario, yeah.
What is that scenario?
The scenario is basically 08.
Yeah.
Like if you want to get a picture of what a dollar rally looks like, where everybody basically stops being able to sleep for a week, just look at what the charts looked like in the second half of 08, starting from about mid-July. Because this didn't begin with Lehman or anything like it. The markets turned earlier. The euro topped at around 160, basically mid-July and of that year. And from there, just this relentless run into cash. And when you get a relentless run into cash, it doesn't matter if it's gold, if it's stocks, if it's crypto, if it's lean hogs, if it's soybeans, whatever, frozen OJ, you name it.
We do love
Everything
our
is
lean
just going to
hogs.
cash. Everything's just going to cash. That's it. People are just washing their hands. Because if you get to a situation like in 08, where the terror in markets is such that credit locks up, the biggest premium is on cash. Because that's what you need to survive if you can't go to credit markets to get more cash. That's sort of the essence of the financial system. Everything runs on cash. You need a letter of credit to import things. I mean, virtually everything runs on the availability of credit to some extent. And if you can't get that, those with the cash survive and those without it die. And so that's really it. So if you get another credit squeeze, if the markets, for whatever reason, and by the way, it's not like we don't have the architecture for a credit squeeze. We just don't have any reason to think it's about to happen now because there's no signs of credit stress in markets to speak of. But it's not like global debt is not at record levels. It is. It's not like debt to GDP ratios are not at insane levels pretty much everywhere. They are. It's not like we don't have all the money that corporates took when rates were zero during COVID. It's not like all that money isn't rolling over right about now because it's mostly 5-year money. It's happening. It's a big risk. Rates are a lot higher. But for right now, there's just not a level of concern in credit markets. Could that concern emerge? Of course it could. Of course it could. And that would be a scenario where everything goes down at the same time. Correlations go to 1. Distinctions between assets and sectors, blah, blah, blah. All of that goes out the window. It's cash or bust.
Cash and Bitcoin.
And definitely not Bitcoin. Bitcoin in that environment can only hope for the magnanimity of the 5 hodlers that own most of it.
And have lost all their
because that's
wallet
by the way,
addresses.
that's
Can't
by the
sell.
way a fun little piece of decentralized finance is it's incredibly centralized.
Well,
Incredibly centralized.
I must
Most
say,
Bitcoin is owned by a tiny handful of people, individuals.
Exactly.
to that point though, during the April crash, we didn't see that big of a move in Bitcoin relative
Right.
to other products. So I
Right.
think there is something to say about the hodler
Yeah.
narrative and how
Of course.
you could certainly see it at least stay more afloat than other products. But yeah, I mean, at the end of the day, it is positively correlated to the market. If everything's going down, you'd imagine that Bitcoin would be going down for the same reason we just discussed of just cash over everything. Wait for the bottom to hit. Wait for your bigger players to tell us where the bottom is, and then you, in an ideal world, you can ride it back up. But
By the way, if you ever wanted to see me get aggressively bullish in an almost nauseating way, that kind of crash,
Yeah.
I would buy everything.
yeah.
Yeah, all
I
in.
mean, if you look, I just had a monthly 20-year chart of SPX. Like, it's just it's comical to me because like here's 08. This is when I like just graduated high school and I was just like, I don't know what I was doing. But here, 2020, you get your sell off. Everyone thinks the world is ending. 2 years later, oh, how about we just double the price of SPX? Same thing here. Violent sell off in April, and we just slingshot the other direction. So it doesn't
is crazy.
like it just doesn't matter what the narrative is. And that's why we say, you know, when volatility is really low, our position sizing is smaller. We have more cash on the side because if we are fortunate enough to have a lot of cash on the side and get a move like this, where we go from 6,300 down to sub 5,000, and you have tons of cash on the side that you can start placing longer bets and getting static long shares of things, like even into a big volatility expansion in SPX or the Qs, if you're buying call options that are 2-3 years out that bring you back to all-time highs, all of those options have 7x, 8x, 10x since the bottom of April. So yeah, I'm totally on board. And the nice thing about these markets that move much faster these days is that if and when that happens, you can see the quick reversals to the upside. Like we saw it in one day, that historic NASDAQ day, where things were paused and the NASDAQ just immediately ripped up like 500 points. It was crazy. So yeah, I hear you.
Even I bought in April because it was just like this is madness.
Yeah.
There's your most
You gotta buy
reliable
that.
signal.
Yeah. And
Yeah.
and I think the one important distinction that we need to make is when we're talking about buying and when you look at historic recoveries, we're talking about indexes, SPX, the Nasdaq. You can
Yeah.
do the same thing in equities, but there are going to be equities that go down and never come back. So
Yes.
don't do the brush stroke of everything will recover. Not everything
No.
will recover. But
Some things will die.
indices,
Some
where-
things won't have the cash.
Exactly.
And they'll die.
Yeah, but indices where all of the money is flowing in a passive way and active way, those have recovered from even the most violent sell-offs. So that's why we say keep cash on the side, trade small, so that you give yourself the opportunity to partake in those moves when they happen. And yeah, that's it.
Well, I mean, so to preempt the natural next question, which is, well, what if everything really does break? Like what happened? Like we've had civilizational breakdowns before. It's not like we haven't. They don't call them the Dark Ages for nothing. We've had periods where things. I mean, world wars more recently, obviously. We've had periods. People are alive today that have lived through periods where the global financial order has come apart. The global financial order is only about 1973 and onward, when Nixon takes the dollar off the gold standard, finally. And sort of everything kind of organizes around that, and that's the world we live in now. So what happens if really the wheels come off the bus? And I mean, my counter to that is, well, you can't trade from a basis in Armageddon. Because if you're trading for Armageddon,
You're gonna be
then-
upset. You're gonna be upset for
first of all,
Many bad days.
I mean, the price of the S&P will be the least of your concerns if that were to be the scenario. The investable assets at that point are canned fish and ammo.
bags of rice. I got one.
Yeah, like
no one's getting it.
if you're really betting for Armageddon, what
$10,000.
makes you think that you're going to be able to get to a market to place a trade and have liquidity?
Yeah.
I mean, if we're really talking about that kind of unraveling,
Yeah.
all bets are off completely. So by engaging with current financial markets, you're kind of inherently saying, well, I'm engaging with this because Armageddon is not where I think this is going.
Correct.
Just philosophically.
Yeah.
Just to zoom in here before we get out of here, Ilya, we spoke yesterday about your SPX, your thoughts slightly bearish, and you said it'll be very quick. You know when you're wrong. Have we proved otherwise today, or do we still have a little more rope?
No, I don't think we proved otherwise today. I think we really were close, but that sell-off on the close
Saved it.
pushed us back to this annoyingly indecisive spot where anywhere you look, S&P, of course, a case in point, you're back at the highs and you couldn't get over. And it's the same in the NASDAQ. You're back at the highs, you couldn't get over. In Russell, you're a little bit soggier. You got back to the range top, as it were, where you've been consolidating since, let's call it about middle of last week. We established a range with a lurch down, and then since then we've kind of held that range. Let's call it between about 24.70, 24.65, something like that, and the bottom at about 24.11, 24.15, something like that. So you're in this tight bracket. It's the same thing, only sort of more potent on the S&P in the sense that you're in a range. Today, you really tried to take that range out. It didn't work. It didn't work in NASDAQ either. And so who knows? But show me a break and I'm out.
All right.
Because I'm not looking to stand in the way of something that is this level of momentum. It's the same idea that we talked about yesterday, Glenn, that essentially, if you look at this not as an investor,
Right.
whose view is, well, the AI supernova is what it is, and stock markets are biased higher, and I'll see you in 5-10 years. Like, whatever, it'll be higher. If your perspective is from a trading sort of, let's even look at the sort of regular tasty methodology, 45 days in. If you're looking at about 5-6 weeks here for a trade, is the risk reward better to be long or short when you are literally pinned at the high and struggling to get over? I mean, obviously the risk reward is to bet short, especially when vol is cheap. That doesn't mean you're going to be right. It just means you get better odds.
Yeah, I think that's
fair. All. That's all. I mean, I'm not super. Who could be philosophically bearish here when the market is telling you that it does not care?
Yeah. I mean, we had this 3-day window where my ears were perked up. I was like, okay, what is this now? And then this was rate cut day, I believe. We got the rate cut. And then they said, oh, down 50? How about up 50? And then just today's move was crazy, though. We were down. I looked last night. We were down like 30, 40. This is almost a 100-point reversal from the bottom to the top. So to your point,
I was almost annoyed overnight.
Yeah.
Because we spent all week saying the shutdown doesn't matter, and then the shutdown happened, and the markets were down overnight. I'm like, oh, they decided to care. No, they didn't.
Gotcha.
Yeah, it's it'll be interesting to see where we go, but volatility is super low. The market seems like it wants to grind higher. Now the government shut down. The interest rate cuts are locked in based on probabilities. Things can change, but doesn't seem like they will. Bad numbers that could move markets are no longer being announced. So it's just like, I don't know what else to say. It's crazy.
You get a hot ISM number on Friday. Let's see what this does. But if it's not a hot ISM number and there is no NFP, there's nothing in the way.
SPX 7000, baby.
Here we
My
go.
Q4 guess is 69.69. So
very nice.
Close.
Book 'em.
Close.
And with that, gentlemen, overtime is out of time. Thank you as ever for joining us. Don't go anywhere. We'll be back in just a few seconds here for Macro Money, where I will talk about this jobs report, which maybe is coming out, maybe isn't. We'll see. And why it is that the markets seem to want a weak U.S. economy. So don't go anywhere.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Frequent trips to Vegas, or there was a year I did a couple of them.
What's the most financially irresponsible thing you've ever done in your life? Doesn't necessarily have to be trading specific.
Financially irresponsible, that's a big question. Like people would say like going to college these days. I don't know. Renting, I like renting. I like the flexibility. I don't know. Maybe renting, I guess, by the book is financially irresponsible. Actually, you know what my biggest purchase right when I started my job was $4,000 on a PC setup, which was not a good idea at my salary point.
I mean, anytime you take a trip to Vegas, it's pretty financially irresponsible. I would say that frequent trips to Vegas, or there was a year I did a couple of them, which was pretty irresponsible.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
The government is shut down in the US, but the markets are up. Okay, how does that make any sense? And where's the Armageddon we were promised? And what's coming up next to infuse these markets with a little bit more directional conviction and where things might head? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to do here is begin with a look at what the markets did today, why they appeared to do what they did, and sort of contextualize that in the sort of scope of what is occurring here with the government shutdown and maybe now less economic data risk for the week than we initially had in mind because of that shutdown. And look at some of the data that came out that might be a stand-in and what's still pending here to give us some kind of a steer if, in fact, we get to a situation where the jobs report that, of course, we were all waiting to see as a major injection of direction into sentiment, if, in fact, the government shutdown will mean that the Bureau of Labor Statistics isn't going to publish that on Friday, and then see what that might mean going forward. So let's first look at the way that these markets performed today. We can see a little bit higher on stocks ultimately. There was certainly a meaningful sell-off in Asian and European hours in the futures overnight, but that did not stick. Once U.S. markets came online, that sell-off was undone, and as we can see here, the S&P at one point was down almost 0.9%, and it finishes the day clearly in the plus column. So the sort of operative question here, really, once the shutdown occurred and markets got a chance to take a crack at what to do, overseas markets thought, oh no, this could be an issue. Once Wall Street came into the fray, negativity melted away, and we came off these lows. Now, what's interesting is that we didn't ultimately cross the swing high in the S&P or the NASDAQ in a closing sense, so we're still nominally in the same range that we've been holding here. But nevertheless, we're certainly not looking at the markets feeling terribly perturbed by this government shutdown. More interestingly, a yield down at the same time, the 10-year off, the 2-year off, in fact, most easing that's reflected in markets tends to be kind of anchored to the 2-year, and that's where the bulk of the move happens today, largely as Fed rate cut odds get firmer. We'll take a look at that here again momentarily, but as you look through this setup, you get a sense that indeed this does seem the most about what this shutdown might mean for the market's favorite bullish catalyst of late, Fed rate cuts. Now, it would be a bit disingenuous to say that gold is up for these reasons. Gold has been up regardless of relative recovery in the dollar since mid-September, a relative recovery in yields since mid-September. But gold's just doing what it's doing. It continues to edge up here, up 0.4%. But the dollar also not exactly one-sided. And there, Fed policy expectations are looking kind of curious because the yen, which is the most kind of directly yields driven of the major currency crosses for the dollar, it does see some gains as yields come in, up 0.5%. But the euro, which is a much better benchmark for the overall direction of the dollar, it was up overnight when futures markets were down and worried. But that is not what we're seeing here. It's given up all those gains, and not for anything euro idiosyncratic, not for any euro-specific reasons. You're seeing something very similar across the major currencies. The dollar is holding up very well. The yen is the only one really making a big move. The pound was up a lot more and is closing up just 0.25%. That's giving up almost more than half of its intraday gains. The Aussie is flat. The Canadian dollar is actually down. So is the franc. And so you're in a situation where the dollar is holding up impressively well, despite whatever this might mean for the structural integrity and the faith and credit of the U.S. government, if anything at all. Because clearly the response in markets here has been to actually buy bonds, hence the lower yields. And so in this kind of thing, we get the sense this is not some sort of a great sovereign risk type of thing that the markets are interpreting, at least for now. Instead, this seems more about what this could mean for Fed easing, and the markets want Fed easing. Looking at the way that things have performed so far this week, nominal gains of close to 1% for the S&P and NASDAQ, a little bit more for the NASDAQ, a little bit less for the S&P. Yields down across the board as we rebuild Fed rate cut expectations closer to where they were in the immediate aftermath of last month's policy meeting. Again, a little bit of a soggier view on the dollar, and that seems to be mostly coming today and yesterday, but not really anything that's gaining significant traction. Now, as far as the government shutdown is concerned, this is a handy chart from the New York Times that shows us how many federal workers are furloughed as a consequence of this, and it helpfully breaks it down by share of department. And really the message here is that the most essential things, Medicare, Medicaid, defense, the DOJ, most of this, Homeland Security, relatively low impact. So the Treasury, only 2% of that workforce is furloughed. Justice Department, only 11%. The EPA, or the Department of Education, over 80%. Now, of course, this gives you a sense not only of the administration's priorities, but also of what are kind of the bare minimum things that need to function. But it does also give you a sense that the economic impact of any kind of shutdown is a long arc. It'll take a while for there to be some sort of meaningful data impact, and that's if the shutdown lasts. We saw the longest one at about 35 days in 2018, and that didn't really move the needle on the economy, but for some episodic pockets here or there that quickly got rebased in the data. So we're looking not so much at the ceiling caving in on the U.S. economy as a kind of headwind, a gradual headwind to economic activity that, from the market's perspective at least, probably means more rate cuts. Now, in so much as we may not get the jobs report this Friday from the Bureau of Labor Statistics as a consequence of this, one data point that typically is not a very good predictor of official numbers, but which for the purposes of this week, if we don't get official numbers, might be our best benchmark. One source of support for markets today, interestingly, in this rate cuts heavy environment, was the jobs report on private sector payrolls from ADP, which is a big processor of HR information and payrolls and so forth. And what we got here was unexpectedly a drop of 32K against expectations of a 50K gain. Moreover, the prior month was revised down from a 50K plus rise, 54K, to a 3K loss. And so what you end up with here then is 2 consecutive months of job losses, according to ADP, for the first time in 5 years, which of course takes us back to COVID and the shutdowns and the rollout of the pandemic. It's the biggest decline since March of 2023 on a given month. That's this right here. But as we can see, that was kind of a one-off. There was some sort of idiosyncratic thing that happened here, but you can see the pace of job gains was about this. So let's say averaging around 110, 120K in this period. So this was the biggest drop since then, but this is not exactly the world's most relevant kind of macro touch point and reference point to say, well, what was happening in the world then was X. This is the biggest decline since then. Are we back at X? It's not that kind of a reference point, and this is not the kind of thing that we seem to be looking at. This seems more like some sort of building momentum slowly for job cuts, and slowly is really the key here. These very modest declines, a mass layoff, this is not across the economy. But nevertheless, it's enough sogginess that the markets might be hopeful for rate cuts. The service sector lost 28,000 jobs, according to this, with most of that being leisure and hospitality, as well as professional and business services. Those were down 19,000 and 13,000 each. There was some gain to be had in education and health services, 33,000 added there. On the goods side of things, the sector lost 3,000 jobs, where construction and manufacturing were the biggest losers, 5K and 2K each. So it looks like the numbers were soggy, but not catastrophic, and that seems to be the sweet spot for the markets here, because what they want is rate cuts, but not economic Armageddon. It was a similar story from the ISM manufacturing report, which again takes on added significance. The Institute of Supply Management is not going to be impacted by these shutdowns. So it'll be interesting to look at what this is, of course, because we have a apparent closure of the government impacting BLS. And so these surveys, the manufacturing and the service sector survey, which comes out on Friday, they have in them an employment component. And because they have an employment component, this might be, sort of in addition to these ADP numbers, a way to get a sense for what's happening with the Fed's new favored bogey, absent the BLS data. And so in that sense, we might have a situation here where this too could start to take on some added significance. And we can see here that at least for the manufacturing side of the equation, we have a relatively benign outcome. It's still a contraction, as ever. This is in the logic of PMIs, where 50 is neutral, above 50 is growth, below 50 is contraction. The further we get above 50, the faster the growth. The further we get below 50, the faster the contraction. And we can see here what we've been looking at essentially since we started to normalize off these heady levels during the catch-up from COVID. This was COVID, obviously. Big, sharp contraction, then a rapid reacceleration as we caught back up, and then that moderated to sort of a more normal pace. And we've established a kind of range for where growth is at this point since about the middle of 2023. And the story there has been of contraction in manufacturing and of a service sector that's kind of holding the economy up. And we're still looking for that service sector number on Friday, but the manufacturing sector number at 49.1, almost exactly in line with the forecasts that were out there. Still a contraction, but the most narrow contraction since the last time that there was growth, or modest growth anyway, at the beginning of the year. So here was this kind of blip, January and February, where we briefly got into expansionary territory on manufacturing. This has been the slowest contraction since then. And if we look at the internals, the price index came down a little bit more. That's encouraging in the sense that inflation pressure eased a little. Employment still deep into contraction territory, where it's been since basically the beginning of the year. But again, the pace of contraction easing. So the market seemingly looked at this again and said, well, falling employment, easing inflation, weak ADP numbers. Sounds like the recipe for the Fed to keep cutting, and to cut in a way that is maybe a little bit more robust. And that's exactly what we see here. The outlook for rate cuts over the rest of this year and next, edging into a more dovish direction. We now have 39 basis points on the board for this year. That's net of the 25 basis points that we've already seen. Then for next year, we're at 64 basis points, and we can see the total tally here shifted back to over 100 basis points, so over 1% in rate cuts. That's the first time that we've been all the way out here in about a week. Markets were a little bit soggier. They, in fact, started this week with only 93 basis points on the board, and obviously we've shifted some. The view for this year has become the most dovish it's been since that rate cut in mid-September. And so what the markets ostensibly are saying here is that the likelihood for October is locked in. No big shock there. We knew that that was coming. It's now 99% versus 96% chance of a cut. December has firmed up. It is now at 87% versus 77 yesterday, almost 88. So it looks like we're going to get these two cuts. But the biggest disconnect still is next year. If we take a look at what the Fed was forecasting when it made its announcement in September, it's got the three cuts there. And as we can see with what happened with yields and what happened with the dollar since this meeting, yields have been down, or yields have been up rather, bonds have been down, and the dollar has been higher. The markets knew that this was coming. They had most of this already priced in. Now, the probabilities weren't as high, especially for December. But the markets had the three cuts already there. So this modest adjustment here from 3.9 to 3.6, from 50 basis points to 75 this year, or from two cuts to three, that really didn't tell the markets much of anything that they didn't already know. The biggest disconnect is for 20 to 26, and of course the year thereafter, but that's far away, and all kinds of things can happen in between now and then. So let's focus speculation on next year. This is only a single rate cut. From 3.6 to 3.4 is 125 basis point cut. The markets clearly think there's going to be at least two. That would be 50 basis points out of 64. And then at 14 basis points baked in the direction of that third cut, we're talking about a probability of that cut of 56%. So just a tad better than even. About a 50-50 shot that there's the third cut, which obviously is miles apart from where the Fed is by at least a cut, maybe two. Now, what's interesting about all of this and why it matters, we can see that once we started to claw back in the wake of the September FOMC meeting, some of this easing, stock markets stalled. They're up today, not surprisingly, because we get a little bit more easing into the mix. And so we're back up at the highs. But this reversal in Fed policy odds in excess of just the one cut, because of course we can clearly see here going from 140 even to 100 basis points is more than a 25 basis point shift. So this is not just taking 25 basis points out of the outlook because they've already occurred. About another whole cut has fallen out of here. And so when you start to put it back in here, the markets seem to like it. It's the flip side for the dollar, which, as we just said, has been recovering since the Fed. But you get this dovish tick, and especially in the yen, as we said earlier, you get the dollar a little bit on the defensive, though it is still holding these lows from July and still seemingly attempting to bottom, dovish speculation notwithstanding. So if we do get a jobs report, we'll see. Some of these shutdowns have been resolved within a single 24 hours, so maybe we'll still get it. That's looking like a 50K gain in the forecast if we see it. The unemployment rate seen holding at 4.3%. Non-controversial numbers at face value. The risk, of course, if the markets are primarily wanting rate cuts and are okay with a weaker economy and want weaker data, is that they may not get it. the direction for U.S. economic data, looking at the City Surprise Index, has been to surprise on the upside increasingly since July. That probably comports nicely with the dollar's attempt at bottoming. And so we can see here that U.S. economic data increasingly beating relative to expectations. Moreover, if we look at the Atlanta Fed's GDP Now model, we can see, never mind what it says about third quarter GDP, that's still ages away, and the model is going to change a bunch between then and now. But more importantly, we can see in the trajectory of this GDP estimate whether incoming data that feeds it every day or every other day as the data comes out, whether that data has been GDP positive or GDP negative. And clearly the model has been GDP positive. The slope of this green line is very easy to discern. And so as we look at this then, we get the sense that U.S. economic activity actually seems to be heating up, not cooling down. And the labor market is, as ever, lagged. So if the Fed is focused on the labor market, and that's old news, and the economy is, in fact, reheating, well, then scope for easing is going to be undermined. And this is why the markets really don't want to see a hot NFP number if they get any NFP number at all. But, of course, ISM does come out on Friday regardless. And that's the service sector, which employs the lion's share of the economy. If that is going to be firmer, especially on the jobs front, then you're not going to have a lot of scope for easing that the markets can really hang their head on. And that can start to look like basically what we've seen in the wake of the FOMC meeting. Soggier stocks and a firmer dollar. And so that's how I'm positioned here still. I haven't done anything with my exposure today. I'm still long the dollar against the Aussie, the pound, the euro, and the Canadian dollar. I still have a little bit of a tactical bearish exposure to stocks, basically just on risk-reward grounds. They're pinned near recent swing highs, and so it's better risk-reward to look for a pullback than otherwise. So I have a little bit of a put vertical exposure in the Russell, the S&P here, and in the NASDAQ. I'm doing it through ETFs just to keep sizing relatively modest and to keep these things cheap so that if they go wrong quickly and not in size. Still long silver, which continues to power higher, and still long the bonds, which was an attempt to buy the dip after the Fed, and that seems to be going okay. The way that I did this was to buy the 89 call and do it as a vertical to keep risk capped, and that seems to be working a bit. And that is the exposure that I will go into the end of the week with here. And then we'll see how it all shakes out, whether we get the data or we don't. And that is Macro Money for today. As ever, we are here right after Overtime, a show I co-host typically with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise commenting at Ilya Spivak on former Twitter and on Blue Sky, and writing for the News and Insights portion of tastylive.com. If you're watching this on YouTube, like and subscribe. Macro Money is back next week. Thanks for watching. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade. Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Forbes called us best online for options trading. With stockbrokers.com, we're #1 for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, of course, Shelly Van, Dan, Cecilia. Full strength here in the cave. And we got the chat popping as well. If you're not on the Tasty Live YouTube, get over to YouTube, go to Tasty Live, and type some crazy shit into the chat. What's up, my friends?
It's October.
We like a sound effect for that. There you go. Dan's got it. It is October. How much? Yeah, all right, yeah. Nice. Like a golf clap for October, you know? Not a quiet start, though, to the markets for the month. What are we up in Bitcoin right now? It's been a nice move back to like 117. I don't know if you guys have it on your screens percentage-wise. I'm trying to get organized over here.
I do not, but I think
7-day percentage return on Bitcoin. We're up 3.5%.
Nice. It feels good, doesn't it?
30-day 8%, 1 year 93%. Does feel good.
How's the chat feeling about October? Let us know. Yeah, I've got Sui up 8%, Aptos kind of getting off the floor as well, 7.5%. XLM, which by the way, I believe XLM, Stellar Lumens transfers are now live in the platform in addition to XRP. So if you want to transfer either of those assets, you can do so. But yeah, green on the screen across the board here, guys. Good start to the month after what was kind of a quiet September up until recently.
Yeah, People were starting to give me dirty looks like they were doubting me, and I was like, give it time, friends, give it time.
It is tough, right? I mean, you can obviously trade futures both ways, and there's some leverage there. You have the listed products through the CME. You can trade those here through Tasty Trade. We are typically active in the spot markets. We'll trade the ETFs like IBIT, ETH-A, some options there. The market's maturing too. I mean, when we were doing this a year ago, you really didn't have the options on the ETFs that you have today. And when they did come out, they weren't that liquid. But yeah, it is a challenge at times when the market isn't doing what we like, right? You've got this long-only, unlevered spot product that I think from a long-term investment perspective makes a lot of sense, at least in my opinion. But day to day, yeah, if you don't get the volatility, it can get a little boring.
Yeah.
What do you guys do when Bitcoin's not going up 5% each day?
I mean, go to the trenches. That's where I'm at.
What are you trading right now?
Well, Dan and I are in punk strategy.
Do tell. Well, I'm not in this.
Ooh. What are we up?
What are we up on Punkster?
Percentage-wise.
Let me look it up real quick.
Like,
yeah, we definitely don't have this on Tasty Trade yet, but if
But if you're asking me what I do as a crypto person, like,
I'm going to go to CoinMarketCap and take a look at this.
Yeah.
So Punk strategy on CoinGecko is up 187% in 7 days.
in 7 days. And when did we get in? Like 2 or 3 weeks ago?
Yeah.
What's the symbol here?
ENKSTR.
STR. Okay. This one?
This one.
14 cents. Oh my God. It was at 12 cents, I think, when you guys had talked about this earlier.
We got in at a penny.
Wow.
Yeah. This is.
So explain this one to me and to everybody else.
Punk strategy is basically a play on MicroStrategy, Michael Saylor's MicroStrategy for CryptoPunks. If people aren't familiar, CryptoPunks are the most valuable NFT on ETH in the entire space, actually, the most valuable NFT.
The first.
One of the first, not the first,
Okay,
but one
yeah.
of the first. And basically what this mechanism does is they created this token, they launched this token. The fees generated from trading this token are being used to buy CryptoPunk NFTs, list them at 1.2 times the floor price. When they sell, they'll take that ETH, buy the token, and burn it. So there's this mechanism where people are betting, there's fees that are generated from trading are being used to accumulate this valuable asset, punks. The previous assets they hold, they're kind of like relisting it, so it's, the floor is increasing as they earn more. And then as they sell out, they're taking the money that they earn and going back to the token, buying it, and reducing supply. So
it's this perpetual machine to keep
Yeah.
the floor on the punks
now let me
moving.
And you guys bought this at, when did you buy this? It's been out for, it appears, like a month.
Yeah, we talked about it on Beans, and we got in around a penny.
That's where the real alpha is, on Beans.
Yeah, it really is. If you guys want to know what's going on in the space, let me read this.
So you guys were in back like a couple weeks ago and just had the explosion here, October, to start the month.
Uh-huh.
Everything's moving higher. Nice trade. And you guys are good.
Thank you.
Thank you.
Yeah. How'd you find out about this? Aside from anyone can find out about it if they watch you on Beans, but where do you guys get your
Dan's
alpha?
a punk holder. We don't give him enough flowers.
He's in the know.
Yeah.
He's in the club.
Twitter and Telegram.
Okay.
Okay, so let me just read this real quick. So there's 4 parts to it. They call it the yo-yo, a simple mechanism for buying and selling punks while burning token supply. 10% of each trade of Punkster, the token, $Punkster, is taken as a fee and stored in the protocol. They take a 2% rake, so 2% house fee. When there's enough fees in the pool, the machine buys a floor punk. The punk automatically gets listed for 1.2 times the price. When the punk is sold, all of the ETH buys and burns the token. And it just perpetually does this.
No manual. It's all in the smart contract, or actually the Uniswap V4 hooks.
Okay.
That's how, so it's all just automatic in perpetuity.
Kind of puts this bid, I suppose, into CryptoPunks NFTs, blue chip NFTs.
Because they also did it for apes, Meebits, a bunch of the blue chips.
Moonbirds, yeah.
Yeah.
Okay.
Cryptos.
Pudgies.
I have a shout out. Jose, when is Ryan going to make appearance on Beans? Well,
Dan's going to be gone.
The
so
perfect
Ryan,
time would be Friday or next
week.
Friday. So
I'll be there. I can do that.
Sweet.
Yeah. Yeah, Jose, when am I going to be invited on Beans is the question.
Aw. Ryan, will you come on Beans with me next week?
Yes.
I might need to show you how to.
Yeah, there's some.
There's a different technical setup over there.
Yeah.
Oh yeah. Now you guys are streaming every Friday on the Tasty Crypto YouTube channel, which I don't know if everybody knows this or not. I'm sure those that are, I guess, like the diehard viewers, which thank you, by the way, everybody that shows up here and types in the chat and joins us on the show week in and week out. Thank you guys. So I'm sure you're familiar with this, but if you're just joining, there's an entire crypto channel for Tasty, which is Tasty Crypto on YouTube. Get over there and you can watch Beans every Friday. Awesome. Well, we got some alpha to start the show. Guys, I've put together a couple of slides and then we can go anywhere as well. We've had a great start to the month. The month is October. We've talked about this, I think, previously on air. I introduced this concept to Tony Batista earlier. It's a lot of fun to talk about this, and this is the, I suppose, seasonal component to crypto markets that we've observed. I've got to caveat that with there's not a very long time frame that we look at, right? It's 10 years, which is a very short period of time relative to many other assets. So when we look at the seasonality, like take that with a grain of salt. Past performance is not indicative of future results, obviously, as we like to say with a disclaimer. But there might be something to this, and we're going to go through the slides. I want to talk about this. Stop me at any point if you have some questions. If anybody in the chat has a question, you know what to do. But October 1st, maybe coincidentally, we've started the month off with a nice rally here in the market, and that's a continuation of what we saw earlier this week, really just to start the week, where we've seen Bitcoin now trade from, let's say, sub 110 back to closer to 120. I think we're at like 117. So we'll see if we have legs here. Nice short-term trade, if not. But October, what do we mean by that? Well, when we look at the last 10 years of price action, and again, we have to consider that we've had an asset that at one point was pennies on the dollar and is now $100,000 or more. So you get these very large percentage moves which can skew it at times. But when we look at the last 10 years, there seems to be a bit of a seasonal component to Bitcoin price performance in the fourth quarter of each year, with October, over that 10-year period, being by far the best performing month. You apparently want to own Bitcoin in October. September tends to be one of the worst performing months. There's the only one here in the 10-year data set where we have a negative return pretty consistently here in September. And August is somewhat muted, June, March. You know, if you've been in this long enough, you know that obviously this has been a great performing asset. But September tends to be down, and then you get October here, where on average, we've gone up 20% when you look at the last 10 years. Do you think it continues?
Hell yes.
Okay.
Yeah, I mean, I think all the signs are pointing to this trend continuing. Maybe not as much as in previous cycles, because obviously the market structure changes over time. But can't argue with that chart.
So to your point, Dan, let's zoom in to the last 5 years. Let's go back to 2020, and you'll see that returns have changed. To some extent, you know, we've got a few more months here where you've had a negative return over the last 5-year period. Market structures changed, participants have changed as well versus where we were, and certainly the price is a lot higher over time. But you still, again, observe that seasonal component here in the fourth quarter of the year. October, even when looking at the last 5 years, is the best performing month on average, up 17% versus the 20% over the 10-year period. But November and December into the end of the year perform pretty well. And even if you go and now look at the start of the year, right, it's possible that we have another couple of quarters in front of us, another 6 months, where we could get decent returns if, big if here, all caps, this follows kind of the historical patterns that we've observed. But we do see that, right? I mean, when you look at the cycles, we've done some of the analysis on the show. You look at the 4-year post-halving cycle when we look at Bitcoin, right? And this is only looking at Bitcoin here for the seasonality chart. But mathematically, they're almost perfect. The drawdowns in terms of the size of the magnitude of the move, or the drawdown of the magnitude of the move on average from trough to peak over those 4-year cycles throughout history has been about 74%. So what I mean by that is, the size of the whole cycle, the up move in terms of the magnitude of that move has declined by about 70%, 74% each cycle. We've done some shows previously looking at where it could go if it plays out the same way.
Explain that. You're saying that like the volatility has kind of come in on it.
So volatility has come down, but what's also interesting to me, fascinating maybe, is when you look at all of the Bitcoin cycles, you measure that 4-year period post-halving, and in each one of those post-halving cycles, you look at what was the size of the return ultimately from that point in time to the peak in the cycle. Now, at the end of the year, at the end of the 4-year period, it might have been a lot lower. It might not have been anywhere near where the peak was, of course. But if you just measure the size of the peak, and then you look at each one of those cycles, the magnitude of that move from the halving to the peak is about 74% lower each cycle. So, it could have been thousands of percentage points initially when the price of Bitcoin was very low around the first or second halving. But as you've moved forward through time, that peak is much lower. Let's just make something up and say it was, it's 150%, which was a 74% decline from the size of the peak before.
Gotcha.
So we did this analysis. I did this with Mad Mike a long time ago, and Frank on the show as well. I think you can still find this on the Tasty Crypto channel. But we looked at, all right, if this happens again and it plays out, you go back to the post-halving period back in, I think it was April 2024 or 2023, one of the two. How far? We're 2 years past the halving?
Oh, you have parent brain, don't you?
I do, yeah. I haven't gotten much sleep recently. I'm sorry. Whenever the last halving was, apologies, I remember it was in April, just not the year. We did this show, and we looked at then, okay, what would it imply if you were to extrapolate this? And at the time, we were using like a $60,000 Bitcoin price. So it must have been just last year.
It must have been, yeah.
You get close to like 180,000 on Bitcoin. Then you did the same thing for ETH, and it got a little silly.
Say that louder.
Yeah, like 160,000, 180, somewhere like 170, give or take, depending on what the starting price was. It was pretty volatile at the time. But the ETH move is crazy. I'll force you to go watch the episode if you want to see what the ETH move was.
We'll share it.
It's fun, at the very least. But that said, again, that is what you see in these cycles. And so if we're still in that period right now, where you're in a bull market, maybe there's a few more months ahead of us here, but October tends to be Uptober, or at least it has historically. So wanted to point this out as we start the month. That said, what else should we expect? So 2 more slides to go through here. When you think about dips and opportunities to take advantage of, if we're in that period, we're still going to experience some volatility. What does that look like historically? So we're looking at inter-month drawdowns only for Q4. So we've isolated October, November, December here, going back over the last 5 years, looking at each one of those months in each year, and looking at what was the largest drawdown and when, to just get a sense of like how this trades and what you might expect. And so the largest drawdown was 32% in December of 2021, and then in November 2022, I think this was around FTX collapse, you got a 30% drawdown in the price, which also aligns with what we've seen historically throughout bull markets, where your pullbacks in Bitcoin have been 25, 30%. Those have been real buyable dips if, in fact, we're still in that structural bear market, which is, again, what we saw if you go back to, I think, April of this year, where we pulled back from like 110 to 75,000. Roughly a 30% drawdown in the price of Bitcoin. Great buying opportunity if you stepped into the market at the time. What happens more frequently, though, are drawdowns in the range of, let's call it 10 to 15%. So I think, again, as long as we recognize that we're still structurally within a bull market, which I think there's a lot of signs that we are, you get a 10 to 15% drawdown and it doesn't materialize into anything larger, that tends to be a pretty viable dip. Maybe you wait. If it's down 15, it's down 20%, you wait. Does it start to recover? That might be the signal. But this is what we've seen historically in the fourth quarter. So while we're all bullish on October going up 20 to whatever percent on average, you do get volatility to the downside. And this in general is what you could expect. On the upside, these are the moves that you could also look for if you're trading this and, you want to put realistic expectations around something. I bought the dip. It's ripping higher. Does it triple? Does it quadruple? No. Some of the biggest moves going back in time, and we had a much lower price, and obviously you had some COVID dynamics early on in the 2020s. 66.9% was your biggest move. More recently, though, almost a 50% move in November of 2024. And if you go back to the chart there, you'll see that Bitcoin was, about 60-some thousand and went up to 90-some thousand and ultimately went higher and pulled back to 75 or so, like we mentioned. But 60 to 90 gets you your roughly 50% move. Wouldn't that be crazy? November, I don't think it repeats, right? But you've seen a lot of kind of consistent upside volatility here too. So you look at that October period, October 2024, 25% move, followed by a 50% move in November. October 2023, 30% move to the upside. October 21, 50% move to the upside. You guys think we get a 50% move to the upside this month? 150, 160 on Bitcoin? We hit that target? I'm not holding you to this. Shelly's like higher.
Shelly's like, yeah, we're going to 180. What's the setup? What's the setup this month that could
affect that?
Push that?
Yeah.
Wrote about this to really high level to some extent this morning in the market update. In my opinion, from what I kind of look at, what I read, what I try to synthesize as well from many people that are much smarter than I am, is that we're either in or entering into an environment in which is generally pretty supportive when you look at the economy. I know there's probably some random ass headlines out there today about the government shutdown and all these things that you absolutely should just ignore unless you think the United States government's going to be shut down into perpetuity. I don't. But don't get distracted by that. There's been a lot of bearishness at times. I think a lot of people, too, look at these moves in gold and equities. They're at all-time highs. There's some, kind of stretched valuations in some areas of the market, and people just wonder how much longer can it continue. Well, first of all, you make money in the bubbles on the upside. You got to get out. You can't be too greedy. You got to take profits at some point. But I think you want to ride that wave. That said, you have the Fed that's cutting here. In terms of the projections, we're looking at a 90% or so probability of another 25 basis point cut at the next meeting, and then another cut this year. Following that, you could get back down to if we say inflation's about 3% or so, a somewhat neutral rate, 3% in Fed funds, I think it's probably your target there. So point being, everything I look at in terms of economic data, starting to see an acceleration in both growth and inflation metrics. We had ISM manufacturing today starting to tick higher. You want to see that in expansionary territory, which is going to be above 50. You're going to get services on Friday. Labor market's been a little shaky at times. So we got NFP, non-farm payrolls here, the jobs report on Friday as well. But generally, some of the things that we're seeing, and there's a lot of different ways that you can slice this, but you look at durable goods recently, you're just starting to see a number of signs of acceleration of economic growth and inflation. It tends to be a great environment for crypto. Tends to be a great environment for tech stocks, long duration assets. I think it tends to be a good environment for commodities too. So we'll see. But if in fact we're in that environment that's generally positive or constructive, and the Fed is cutting into that, and we move away from some concern that the Fed is cutting because things are really slowing down, and it's more of this, soft landing, they're going to land the plane perfectly sort of thing, then I really think you could see a lot of people jump back into the market. We've just looked at seasonally a period of time where the summer tends to be underperformance at times in September. We also know that historically, if you have a positive September, which I think we were kind of right near there, October's even better, or the fourth quarter is even better. I just think people have been too bearish, or maybe more so, too apathetic. People might care again. I talked about this on Monday, but look at the index for Bitcoin or pick your other favorite crypto term in terms of Google search trends. Nobody cares, guys.
But
there's no FOMO. Like, who's talking about it?
But we talked about this too. If you want to hop in too, but like we talked about this where this cycle, in my opinion, is a cycle of like institutions and bigger flows, right? Like previous cycles, I feel like the massive run up, this kind of like FOMO spike in prices was retail driven. And I feel like this cycle with the Bitcoin ETF, with some of the ETH ETFs, MicroStrategy, this like public market or like legitimate way of accessing the asset class, it dampens the like volatility, even though flows move into the space. So yeah, I mean, people might not care from the retail standpoint, but it seems like our bigger asset managers are,
Mm-hmm. And I think that's what you need to see, right? To your point, it might not be as volatile. And so maybe we don't get these moves. But I would still take, just to get you to some of these levels where you've had a great month, right? 10%, 15%, 20%. It's definitely not that 50% move in November, but think about the price at the time, right? We're talking about something that was $60,000 here versus something that's 120, 110, 100. You get one of these moves that we've historically realized at this point. And again, you want to take profits, I think, at the end of all of this, right? We're going to do a show where we're probably talking about taking money off of the table, if you haven't already, into some of these up moves. But off of that $100,000 base, you do get to new all-time highs if we see this play out. And again, this does not at all mean that it's going to repeat. You could have a negative Q4. Who knows? We're just looking back at the data that we do have, and it is interesting enough. But I think to your point, Dan, so volatility comes down. But I think in order for the crypto market to get to, in terms of total market cap, to these new highs, you obviously have to have these bigger pools of capital that are entering into the space, these institutions, whether it's larger funds or it's kind of from the sovereign bid, if it's countries that are looking to allocate. And I'm sure that some in the shadows already are, right? You see the bid in gold, and some of this is just driven by rates and the dollar. But I think that's where it comes from. So you might have less volatility, but you get to much, much higher prices because there's bigger inflows. We're seeing those billion-dollar inflows into the ETF complex on sometimes daily.
I have someone in the chat, Mauser. What month did the government give its blessing to the crypto ETFs? I don't know if he means like SEC approval, but
yeah, I don't know if it's the approval or the launch. Let me do a quick.
2024, wasn't it?
2024. I think we launched like right around January. Was the launch or the? Yeah, I don't know. We're gonna have to go to Google.
Let's go to
this
Google.
one. Yeah. I don't know if you want to take a look.
Yeah.
I'll see what I can pull up here. Yeah, it's a good question. Yeah, I think it was January 2024.
January 10th, 2024 was the launch. They officially approved several spot Bitcoin ETFs January 10th, 2024. Yeah. Yep.
Yeah, I think there's going to be less volatility, and you're definitely not going to see the same upside returns. It's going to dampen over time. But I think there's still, a bullish trend that's clearly in play here. And I think back to some of the headlines that we've seen recently. We get super excited about them, and then we completely forget that they happened. For example, 401k plans can invest in alternative assets, real estate, private equity, crypto, right? And that's where the majority of the funds are going to go into. That doesn't happen immediately, and it doesn't happen across all 401k plans. But when you start to hook more of these pipes up for capital flows, it has an impact over time. Same thing with the ETFs, right? ETFs launch, I believe if I'm correct, if I recall correctly, bid in the market leading up to that point. ETFs launch, there's probably a big correction afterwards.
That's what I mean. So here's an interesting point. Flower Power 222. I really want to go bullish on Circle stock, as I feel it's going to be over $1,000 sometimes in the future. Just don't know when to buy big or just DCA in. What do you guys think? And you just mentioned blow up. This to me is one of the same trades as Coinbase stock last cycle. Coinbase stock went public at like I think it was like $300 a share, somewhere around there. And then it trades, all this mania trades up until 2021, 2022. It crashed to $50, $40, $50 in the depths of the bear. And I just feel like, you know, it's a similar thing, right? Stable coins is the hot narrative this cycle. Circle's a stable coin stock. Well, you know, it went live, and what did it do? It traded up to $250. I mean, it's down to 130. I mean, I don't see why you wouldn't nibble. You can nibble a little bit here, but I wouldn't empty your clip into Circle. It's only been public for what, 3 months? Not even.
You know, if you haven't had it already, there's going to be an unlock where you could get some selling pressure there from insiders. I don't know if that's happened or not yet. I think that, you know, typically 90 days or more.
Go out a year. Go out a year in the options and just, I don't know. Let's just see.
Yeah, let's just look at, you know, a little bit more than a year here, but, you know, basically December 2026. All right, I don't think Circle's a zero.
No.
It would be odd. Something went horribly wrong. There is an interest rate component to this, right? So when you think about the business, Circle is going to issue stable coins. They don't pass that yield on necessarily, at least not directly to users. If they have they have a relationship or partnership with Coinbase. So if you hold USDC with Coinbase, you're going to get like 4.5%. That's going to come down as Fed funds come down. So point being is like this impacts their margins. They're less profitable from an interest rate perspective, right? If rates are just zero and they stay there, Circle's probably less interesting to people, though they maybe figure out a way to generate fees. But the lowest strike that I can see here, if this is looking at all of the strikes, I think we've got all the strikes up here. But I've got a 60 strike, and it's about $6. And so if you sell that, that's going to be a buying power. Let me get the shares off there. Apologies. Sell the 60 strike. My buying power reduction here in a margin account at Tasty Trade is about $1,600. And I'm going to bring in, we'll just use the bid here that you would sell at if you wanted to be filled immediately. You could probably work this at $6 at the mid price. So you're going to bring in $500 to $600 depending on where you get filled if you were to get filled there. Not bad against a margin requirement of about $1,600. Now, you're going to hold this position to realize the full profit. Obviously, you could make some money here if the price just absolutely ripped higher. You'd see that option trade a little bit cheaper, but it's not going to lose all its value because there's a lot of time premium in here at 443 days. So you're locking up capital for a long time. But as an example, like that's one way where you could have that bullish exposure. You know, we're looking at the 8 delta. Maybe you want to be a little bit more aggressive because the stock's at 128, 130 right now. But maybe you think, you know, I would like to buy Circle at $100 a share. I'm bullish on Circle. Well, you get paid almost $2,000 against a $3,700, $3,800 buying power requirement here to put that on with like a 400-day duration. You can move this around clearly. And you can look at, you know, okay, the next 16 days. I don't think it's going to go to 100 in the next 16 days. Crazy things have happened, though. But if it doesn't go to 100 in the next 16 days, if you want to buy it there, you do have a similar buying power reduction, obviously. But you're going to bring in $58 in premium. And you can just do that every week at the $100 strike. You're going to get paid less if it does go higher, right? So you could have that Delta 1 component where you're just long the shares. But there's a lot of ways to do this in addition to dollar cost averaging. You can do this with other crypto-related stocks as well.
We're not able to share watch lists across different accounts, are we? Because the one,
I don't think so.
You don't think so?
I don't think there's a way, at least not like as a feature. I don't think there's a way where if you built a watch list, you could send it to us, but we could put it together for people.
We should. So the last couple weeks, I don't know if we'll do it this week, but the last couple weeks, I had put together a list of all of the crypto treasury companies, the DATs that we've been following, crypto treasury companies, and I have a watch list. And what I really want to do is I want to figure out which ones, like how to play some of these with options, because some of these are, I don't know, they're pretty rich. They might rip higher. Like this Forward Industries, for example, is accumulating over $1 billion worth of SOL. Is that a levered bet on SOL? Maybe, but it has options, or it will. UPXI, same thing. SUIG. Let's just even look at SBET, right? Like SBET is the Sharplink Gaming. Bitmine Technologies, right, is the Tom Lee one.
Yeah. I mean, you look at the vol in here, if we just use this smooth VIX style calculation, 100%, which is a hell of a lot higher than the ETH vol right now. We know realized vol is certainly not 100% in ETH.
Right. So, and I don't know how much volume there is, but if we look at that and, do we sell?
I got 16.5 million shares traded today.
It's not bad.
No, options are a nickel wide.
It's pretty decent. I don't know what you would do. I mean, maybe you sell call spreads and see. I think that these are going to blow up at some point.
Like to the upside or the downside? See, when we're talking crypto blow up, I mean, what are we talking about, Shelly?
Both. So you got to play both. You got to play for that immediate short-term upside move, but then hedge yourself to the downside because I feel like these are. I mean, what are these? These are levered bet. It's a levered bet on ETH, is what I think, right? And, maybe you have to do some analysis, get ChatGPT to dig into the financial statements and news and see if they're running.
Or watch Beans.
But are they running alpha strategies on top of this? Like, are they doing DeFi? Because a lot of these are doing leveraged DeFi strategies with the fund.
I think so. That seems to be like the value prop. Otherwise, I mean, maybe from the institutional perspective, it's just easier to buy some of these things. That said, I mean, there's ETH ETFs with options on them, so I'm not quite sure what the allure of SBET is versus an ETH ETF as an institution. But if they're able to participate on chain in ways that generate yield, then okay, makes a little bit of sense why you might pay a premium for that.
Right.
Why do you think they're going to blow up?
Well, because it's just, I don't know, it's just common. I don't know. I feel like it's just common sense.
It's over-levered.
Yeah, it just starts
at some point in the cycle.
Yeah, it starts with MicroStrategy. It's like, it's a good idea. He got, started accumulating Bitcoin. It's a great idea. And then as we see in finance, people pile onto this trade. Now we're raising for ETH. It's like, okay, ETH is not, it's not as risky. It's definitely riskier than Bitcoin, but it's not as risky as some of these other ones. But we've interviewed the guy from Sui. I mean, that's a newer token. I'm not saying what he's doing is, I'm not saying what he's doing is.
You're just saying that, like, look, there's risk here. There's company-specific risk. There's strategy-specific risk versus owning the underlying asset in this case. Similar to, like, okay, you got gold miners.
Yeah, and like I think I interviewed the Athena stablecoin one on last Wednesday, and he talks about a beta and an alpha component. It's a SPAC. They raised $890 million. There's some other things they're doing, right? They're participating in the protocol. They're governing. It's not necessarily that it's just like some hedge fund. It's just that he talked about a beta and alpha component to the trade. And the alpha component is going out and doing yield strategies. And the Athena protocol, if people don't know, is a yield-bearing stablecoin, and the yield comes from the carry trade. Carry trades, they work and they're very common, but they do blow up. It's so my point is that it's leverage on leverage, and some of this doesn't. If you're a crypto native, just buy the token, right?
Yeah.
So it doesn't seem sustainable, is what I'm trying to say. If I'm just using heuristics, that's all.
Shelly, we're going to give you the last word here. We've run quite over, so apologies to the production team, but thank you for giving us the time here today. I think we had a great show. There's a lot going on. It is October, after all. What are you seeing in the market? Where's the alpha? What are your alpha yield strategies?
Oh, good grief. I'm watching a lot of things in DeFi and, again, in the trenches, but I'm very excited that we now offer Uniswap at tastytrade.
Yes.
Good call out.
That's one of my favorite trades.
Yeah, Uniswap launched yesterday alongside Arbitrum and BAT. We had a couple little bugs we had to fix, but I think that should be good to go now. If not, we'll have that this week. And then also XRP and XLM transfers now live. Awesome. Well, guys, thanks for joining me here in the cave. Thank you all for tuning in, watching the show, and joining us
We'll be back
in the
tomorrow at
chat.
3.
Oh, that's right. It's Crypto Week.
It's Crypto
How
Week.
could I forget? We're here all week. I'll be on Beans, and we'll be back tomorrow at 3 o'clock. New time. Same show. Same alpha. More alpha.
More alpha.
New time. Shelly and I will be back. But until then, I'm Ryan.
I'm Shelly.
I'm Dan.
Peace.